let's get in Nishchal Maheshwari, Head of Research at Edelweiss Securities. This is an endeavor that ET Now and Edelweiss started, I guess, 18 or 24 months ago. The Edelweiss ET Now Lead Indicator Index, which tries to give you an advanced intimation of what the economic activity is likely to be. Nishchal Johnson to speak about that. Nishchal, good having you. Thanks so much for joining in. Lots to talk about. We'll try and make it a bit of a rapid fire. But the indicator index, I believe, stood at 97 for the first quarter of FY13 versus 95 for quarter 4. What does this imply?
I think the indicator, as the numbers imply, basically 95 to 97, I think more or less in the same range. But what it is saying is, I just want to tell you a bit here, is the last year the worst number which the indicator went down to was around 86, 87. That was the second quarter of the last year. And then we had, the third quarter of the last year. And then in the fourth quarter, the indicator went up from 86, 87 to 95, and now it's holding on to 95, 96. So some amount of recovery is there. The recovery is not as strong as what we had expected. But for the economy, what the indicator is indicating to you is that the worst is already behind us.
Okay. So I believe you mentioned that economic activity bottomed out in quarter 3 and subsequent pickup probably has not been as sharp. So is there a sense that you're getting, or is that a sign that the indicator is throwing that it's pretty much plateaued right now? It may have bottomed out, but it's not showing that bit of a pickup.
Yes, see, this is a 3-year-old indicator actually, and we tracked this indicator even in the 08-09 era, when the whole economy just collapsed and then came back very, very sharply in the next 2 quarters. That time also the indicator had gone down to as low as around 83, 84. But in the next 2 quarters, the jump up was very, very sharp and went back to around 107, 108. And this time we have seen is basically that the recovery is not as strong as what had happened during 09 time. And obviously the government stimulus was available out there. And that is what we are missing this time. So you are saying that the bottom has been made. There is some amount of recovery, but it is not strong.
Right. Your reports also point out that quarter 1 FY13, the lead indicator index points to stabilization of trends seen in fourth quarter of last financial year. What are the factors that you think that support the index and drag it?
See, this is a combination of 9 indicators. IIP is not one of them. We look at indicators like cement production, automobile production, interest rates, inflation. So there are 9 indicators which are combined in this, and this indicator gives you the non-agri GDP. So agri GDP is not combined in this, but it gives you a fairly good picture on the non-agri GDP. And what are the 2 or 3 things which have been driving this or making it stable? Last quarter it was cement production was very good. And the current quarter, it is the automobile production, basically, especially the MHCV, which has been holding up the index. And I just want to highlight here is that we take a lead or lag of around 3 to 6 months or up to 9 months also, because we want to see how the lead indicator. So suppose a hike in interest rate or a cut in interest rate has happened, but when it's going to impact the economy is we have done empirical running of these numbers basically for the last 15 years, and thereafter we have seen what is the best fit.
So tie it up, Nishchal, with what the indicator is indicating in terms of specific sectors, 1 or 2, and how would you correlate this with what the market could perceive if indeed the economic activity pretty much mirrors exactly what the Edelweiss ET Now Lead Indicator Index is showing?
So if you really look at it, the IIP numbers and all, so bottom was made in the third quarter of last year, and thereafter in the fourth quarter we saw a bit of a jump basically, but the IIP number once again last month was in the negative territory. I wouldn't really be bothered about a monthly number basically, because on a 3-month trend IIP is still up, and would wait for another 1 or 2 months before becoming very negative on the outlook. For the moment, I think that is why it is tying up, saying that we had a hit a bottom around 86, 87, then went up to 95 and then to 97. So more or less the same trajectory is going on. Some of these sectors to tie it up, I think we are seeing good production on the cement side. We are seeing good numbers on the automobile side. These are some of the indicators basically which, or some of the industries which are getting directly implicated in this.
How do you react to the events or the updates coming out of Europe at this point?
I think obviously the short-term volatility is going to be very high. I have this strong view that eventually ECB, which is the European Central Bank, has to go the way which Fed did. Basically, they have to be the lender of last resort, and they need to buy the toxic assets out of the bank rather than giving money to the bank to buy more of the toxic assets again. So that is what my view remains to be, and obviously I think Europe is coming around to saying that only austerity is not going to work. It has to be the Keynesian policy, basically, that growth has to it should be led by growth rather than by austerity measures. So with growth you are going to come out of the problem rather than by cutting consumption and leading to austerity measures. I think somewhere you are going to find a midway between the two, but less of austerity is what I definitely foresee. I also foresee a couple of more things basically out there, that at some point of time you will see an LTRO, another LTRO 3 or a QE3 likely to happen in the next 6 months. So ample liquidity is going to be the norm of the day for at least next 6 months to a year.
Okay, Europe is a deep gash of red, 1.5% for CAC and DAX. So mind you, that is not looking too good. But Nishal, before we thank you, a lot of voices in the last 2 weeks have been speaking about this being a great time, in their view of course, to accumulate some blue chip stocks, or essentially ideas that they firmly believe in. You think this is a good time? Are you recommending that to your clients from a 12-month, 18-month, 24-month perspective, that this is a good time? And if so, where are you finding those bargains?
We have this series known as Brave Art series, actually, where we look at businesses where the outlook is clearly beyond 12 months. So 12 to 36 months is the outlook, where we look at businesses which have got a stable business, stable margins. Cash flows are improving. So I'm saying I necessarily don't mean to buy businesses which are free cash flow, but at least cash flows are improving for them. ROE, ROC margins are stable or improving. So there are, in this category, I think there are a lot of stocks which are right now available. One of them we recently are working on is ZTV. That looks pretty interesting. Bharti is another interesting stock out there. GMR Infra is another interesting stock out there. Now, these calls are basically from more than 12 months very clearly, because 12 months in the short term, especially in case of Bharti, you do not really know what is the cost of the 2G license going to be, because that's going to be the price for every other telecom operator. But that is a short-term view, and that may still cause a bit of a gash there. But I think on a longer-term basis, you have this very, very strong franchise which is available. Huge company which is throwing EBITDA of northwards of 30,000 crores a year. So I think there's a great business out there which is available at pretty cheap valuations. So this is the way we are going out and identifying, and I think there is enough of these companies, blue chips around.